So Patti, we had a fantastic episode today. Sebastian, is always such a pleasure to have him from Arcum talking about retaining merchant accounts.
Yes.
Which on the surface sounds a little boring, but imagine if somebody could literally give you a spreadsheet and said, here are all the merchants that are probably going to cancel over the next 12 months.
Right.
Where you could direct resources. I mean, that is literally what they're doing.
What a savings, of
It's
time,
incredible.
of energy, of money. And
Yes.
I really love the way, I think Sebastian is so good at explaining this. I mean,
Yes.
obviously it took quite a bit of brain power to come up with what he came up with, the algorithms and so forth. But, I've talked to Sebastian numerous times over the last couple of years, and the more this gets refined, the more obvious it seems to me.
Yeah, they definitely know what they're doing over there. So it's exciting. And the questions from the field, I'm going to leave you in suspense, other than to say that I actually talked to a real agent. So I've been trying to do this more and more, where I actually bring in a separate Zoom call that I did with an actual agent that had a question for the field. So that's what we're going to do today.
Fun. And my report is on tokenization. It's one of those things that it's a word we throw around a lot, but we get a little bit more detail of what it means and what's going on in terms of card tokenization these days. So our this episode is sponsored by nmi.com. And James, what do you say we get going?
Let's start our interview. And then, of course, in the Insiders Report, we also get to talk about NMI. So you're going to want to stick around for that as well. I think it'll help you to understand a little more of what a gateway does and the tokenization. I thought that was great. So with that being said, let's start our interview with Sebastian.
Let's do it.
Hey, everybody. Patti and I are here today with Sebastian, who is the CEO and founder of Arcum Partners. How are you doing today, Sebastian?
Pretty good, James. Pretty good. It's great to be back.
Nice to have you back.
So let's see, Sebastian, it's been a little while since we had you on the podcast. And so for those that maybe missed the last one, give us a little bit of an introduction of who you are and kind of your journey in the industry. And then tell us Arcum Partners, like what is that? What do you guys do? And maybe share a little update with us if you would.
Absolutely. So in short, we ultimately help processors, acquirers, ISOs, anybody who pretty much focuses on acquiring merchants to better retain those accounts by analyzing who will be churning, why are those accounts churning, and provided those insights many times 12 months in advance. So our clients can proactively engage those customers, retain them for longer, solve problems, and increase customer lifetime value.
Love it. That's great. And how's it going? So you've been doing this for a little while. I mean, are you seeing some success? What kind of success are you seeing? Give us a little update on kind of where Arcum Partners is at in its journey. I know it's a startup, so kind of give us, that's an exciting thing in our industry. So tell us a little bit about kind of where you're at in the journey.
Yeah, absolutely. So I think last time we spoke, we were still, for the most part, operating out of Excel spreadsheets. So we would send up a list of clients. Hey, these are the merchants who are likely to churn. This is why they're churning. This is some information about them in terms of industry code, processing volume, revenue, etc. But now we kind of switched that up. I think I mentioned to you, we did a small raise not too long ago, and for that primarily was to enhance our product offering. So now we actually, as any tech firm, we wouldn't really be a technology company if we didn't have a fancy dashboard with some charts. So we decided to really productize our algorithm, deliver that to the client in a way that is very intuitive, very simple, not too many bells and whistles, strictly focusing on what we do best, and that is helping you identify merchants who are going to be churning your portfolio. Why are they churning? And some additional characteristics about them, so you know specifically what solution to offer them when contacting that particular account.
Yeah, love it. Okay. All right. So I want to start by kind of zooming out a little bit and talking about the scope and like how big of a problem attrition is for the acquirer ISO community. Frankly, this is one of those problems that's always baffled me a little bit as far as why our industry does not seem to care about it very much. I don't know what the deal is with that. I mean, I know they're starting to see the light with a company like yours, making a dent. So talk to our audience about this. I mean, why should they care about attrition? How big of a deal is it? How big of a problem is this that needs to be solved?
Let's first start with, how big is this problem? And I, talking to investors, this is what we refer as total addressable market, right? And the TAM for this particular problem is huge. Let's kind of give you a top-down approach or analysis for that. There's roughly $7 trillion in credit card and debit volume going on every single year. Out of that, let's be conservative, roughly 10% of that amount is expected to churn every single year. So we're looking at $700 billion at risk every single year. Throw on top of that, let's add, 1% in net revenue after we accounted for interchange fees, network fees, etc. So we're looking roughly at about $7 billion in net revenue that are being lost every single year in our industry. And granted, this is not necessarily accounts that are leaving and just never coming back. No, these are accounts that for the most part are switching over to another processor.
Right.
And now with the rise of companies like Toast, Square, they're switching over, and with the additional value add these companies or ISV providers provide, it really becomes a matter of, are they really coming back in circulation to the ecosystem of the actual traditional acquire, et cetera? And I don't know the answer to that, but I would say more and more every year, some of that percentage that is churning and is going to these accounts, it's not coming back to be acquired by a traditional ISO and acquire. So I would say, this is very problematic in terms of, why is it important? Well, churn is it's counterintuitive when it comes to growth, right? So you want to grow your portfolio. This is an industry that we spend a lot of money when it comes to acquiring a merchant, whether that's with free terminals or bonuses that we give up front to the agents for closing an account. For opening an account. And to be honest, very few people have a sense of what is the true cost of acquiring a merchant. Mm-hmm. And spending a lot of this money in the front end and completely neglecting the account once that account has been boarded. I think it's, problematic not only for ISOs, but as an industry as a whole. Since, at the end of the day, we come to realize that, hey, it's so much cheaper to retain an account than it is to go out there and acquire a new one.
Sure.
Yeah, one of the things I love about what you're doing, Sebastian, is I like that, excuse me, you're kind of quantifying this in a unique way, meaning, the reason people put a lot of money into the acquisition is that there's this kind of clear and obvious thing. I spend this money, I acquire these accounts.
Right.
But with attrition, it's a little more subjective, or at least it has been. And so it's kind of like, well, I don't know who's going to cancel. So how am I going to effectively put money into this? Whereas you're kind of saying, hey, here's the list of 100, 1,000, 10,000, depending on how big, here's a list of merchants that are probably going to cancel. So now you can kind of focus your resources and say, okay, well, wait a minute. If I know these are the 1,000 accounts that are going to cancel, how much would I pay to keep those accounts? And then they can allocate resources, appropriately for that. So the $1 million question, which I know is obviously not one that you can really answer per se on a podcast, but broadly speaking, broad trends, what is causing the attrition for ISOs and acquirers? Are there some significant trends that you've seen or some insights that you could share along those lines of just kind of now that you've had a lot more data to look at?
Absolutely. So Patti actually did a phenomenal article on this on the Green Sheet, specifically highlighting, specifically highlighting the 5 main components that we focus on when it comes to flagging a merchant at risk of churn. And a lot of, you talk to a lot of people, a lot of folks always think it goes back to pricing, but that's a huge misconception, because we see in the data all the time that merchants are willing to switch over to and pay higher in fees if that means a better service. If that means that on a Saturday when my POS goes down, I can rely on calling someone to answer the phone and that problem will be solved. So for the most part, we think that the main, and again, the main driver behind churn that we're seeing, it's agents, agent offering, getting a better split from residuals from one company and sending those accounts over to another acquirer. Again, this is just part of business. And I think this is going back to your last point. This is the reason why I think it's such a persistent problem in the industry, because we consider it as, hey, this is just the cost of doing business. If I'm acquiring accounts are going to churn. But we're hoping to change that dynamic and sort of perception a bit and say, actually, you don't have to take attrition as given. There's actual levers that you can pull and technology you can leverage in order to better solve this problem. So going down the list, agent is the main driver normally we see when it comes to driving attrition. The next one will be product, and this is, does my terminal does it have NFC capability? Is it tap and go? Does it bring any type of operational efficiency for my business if I'm using it? So I'll be product related. Service related is, how many times am I calling a month, and am my problems being solved once I'm calling customer service? So we got agent, product, service. Of course, pricing is a big driver as well. but not the main one. I would want to stress. And last but not least, we have information about the zip code where these merchants are located. So many times we look at the economic conditions for that specific zip code as to identify whether this merchant is likely to churn because of economic reasons. Just because we're seeing a recession in Atlanta, that does not mean that a place like Miami is also slowing down. It could be very localized. So that's kind of how we break down churn in terms of external drivers and internal drivers. External drivers being something like the economy, internal drivers being things like pricing, agent, product, and service.
So tell me, Sebastian, why does our industry need a company like Arcum? Why can't, ISOs and acquirers be doing this themselves? What are you doing that they either are not or cannot be doing in this area?
I would say that they could be doing something about it,
Okay.
but again, it's also very expensive. Predicting
Okay.
churn is a very complicated problem. We've been working at
A lot of
this.
computing power, you mean by complicated, or more?
It's more even human capital associated
Okay.
with it. Again, it's not
Gotta
just,
ask the
hey,
right questions.
Right. And having the right people to answer those questions and dabble into the data. It's not like, hey, let me hire 2 economists to come and build me a churn model and figure this problem out. No, if those economists have never dabbled with payments data, it becomes very difficult for them to really see how the dynamics of pricing, network fees, more fixed fees like PCI compliance come into play when it comes to actually predicting churn. So I go about and say, I would say to ISOs, this is very expensive. They can try to hire 3-4 data scientists to try to hammer this problem out, but does that guarantee a possible solution to the problem? Absolutely not. There's a lot of risk associated with going ahead and implementing a new problem, a new project, or a new solution. We have been working this, from the payments industry all the way to, the newspaper or publication industry, where essentially me and my co-founder got our first jobs out of, right? So we have been exposed to this problem going back, 6-7 years already, where we have really studied it, analyzed it, and tested many of the new methodologies that we have been able to build. A lot of them came pure sheer luck, to trying new things and having some type of feedback from the client to make sure that, hey, actually, is this aligned with a product that you would be willing to buy to solve your churn problems, or are we missing something? And that's kind of where the ability, or I would say the advantage of being a startup is, where our clients, especially the early days or very early pilots, they were very willing to, hey, let's try new things. If it doesn't work, sure, let's go back to the drawing board, send us a new list, we'll compare this new list. And we did this time and time again. In fact, all of last year was spent around really honing in this methodology so we can ensure that, hey, whatever portfolio we deploy this to, whether it's a 5,000 merchant retail ISO, or is it a 300,000 merchant super ISO, we can expect a certain level of results. And ultimately, those results ultimately drive lower churn. And at the end of the day, more money for the ISO, more money down the drain. Down the, how do you call that? Down the funnel to the agent, making more in residuals.
Sure,
But this is
sure.
something that a problem that, it's not just an ISO problem. It's also trickles down all the way to the agent. If you think about it, if you're an agent and some ISO offers you, a 90% split on your residuals, but the churn rate is closer to, 20-30%. Is that any better from someone offering you 80% split on their residuals, yet the retention rate is closer to 95%? These are things that even the agent ought to consider when it comes to where are they placing their accounts.
So that's really cool, because what you're really saying is it's an issue of numbers as well as applicability, right? Yeah.
Absolutely. It's not just crunching the numbers. Is,
right.
Hey, do you have knowledge in the industry where you can even crunch these numbers and provide something that is useful?
Right.
To give you an idea about that, when I first got started, our models would be very accurate. But guess what? A lot of those merchants that we initially flagged will churn in the following month. Well, we would go back to the clients and say, hey, is this good enough for you? And say, listen, many times we experience a data delay where we don't get to see our data for 30 days after what has already occurred. Therefore, we have to work a way out to be able to push that signal later into time,
Right.
so that our clients had enough time to proactively engage those accounts,
Right.
rebuild that relationship, and retain that account for longer.
Right. So it's sort of an opportunity cost issue at that point. So let's say, you know, I'm an ISO or a large processing company, I'm using Arcum. What do I do once you get this information, you know, on, you know, accounts that are likely to cancel? You know, obviously I can't just go flip a button and, you know, and attrition goes away. What do I as an ISO need to do with this information? And sort of take that to one step further too, if you don't mind, Sebastian. And it would seem to me that we're talking really about some changes our industry needs to make in order to minimize attrition that these individuals, you know, the individual ISO is doing with that information you give them. There's sort of a bigger picture here, right?
Absolutely, absolutely. And if you think about it, you know, what are some things that, you know, an ISO can do once we provide them this insights? It's, you know, we like to break this down into two types of potential strategies. Ones are like soft touches. For example, you know, me calling you, hey, Patti, how are you? I'm your merchant acquirer. I know these are tough recessionary times ahead. I'm here to help you. Is there anything in particular that I can be useful to you? That's a soft touch.
Right.
If it's a small account, you know, you can probably get away with just sending an email, letting them know, hey, Patti, I am here for you. I'm your acquirer. There's anything I can do to potentially help you navigate these tough times. Know that you can rely on us. That's a soft touch. Costs very little. A lot of the times you already have retention managers on the team that can essentially deploy these soft touch strategies. Harder touch strategies. These will be maybe geared towards bigger accounts where margin is higher. Accounts that require maybe more a more personal touch, and this could be something as simple as, hey, I know that you're a restaurant processing, you know, $1 million in sales volume every single month. You're big enough where it makes sense to give you a free POS that helps you with your operational efficiencies to make sure that you can have your employees can clock in, can clock out, table management, etc., so that we can really solve some of the issues that may be present in that specific merchant, right? So these are obviously harder touches, which entail higher fee or a higher expense, right, to deploy. But at the end of the day, you know, when you align sort of these big accounts, these merchant accounts are processing significant amount of volume, you know, what would you pay to keep that account? And what are you willing to provide in the front end, you know, whether that's a price reduction or a new free terminal? What are you willing to do in order to actually retain that account, not just for 12 more months, you know, how about for an additional 24 months and 36 months? That's where we really get to see sort of the dividends of this type of strategy being played out, where the customer lifetime value increases so significant that it almost pays for itself after a couple of months or, you know, 6 months of actually having deployed that proactive retention strategy.
So what you're saying is that they need to be more proactive, whether or not they're using Arcum or something else. And I think that James and I have talked about this a lot. You know, there isn't necessarily that proactive strategy towards retention. And what you're saying, I believe, is that Arcum sort of helps direct the industry that way.
Absolutely, Patti. And one of the things that, you know, I want to stress as well is, you know, again, at the end of the day, we recently partnered up with Popcodes. So, you know, any merchants that we flag who are at risk of churning, we know why they're churning. Now Popcodes can go ahead and deploy messages directly at the point of sale terminal, so that though that particular merchant can see, for example, hey, you qualify for a reduction in your fees. Click here or scan this QR code to learn more. This is engaging the customer directly at the front lines, at their store, at their POS terminal, right? So the ability to be proactive, again, you know, if you don't have to use us by any means, but what you have to realize is that we're in an industry where resources are relatively scarce. You know, if you have a team, an ISO with, you know, 50,000 merchants, for example, you more likely have close to, you know, 4 to 6 retention managers. Now, having 6 retention managers focus on 50,000 accounts, that's a big job. I wouldn't want to have, to be honest with you, right? But what if we could leverage technology to focus on those accounts that need our attention the most? Not every account,
or so, right?
The 500 or so that will be churning if nothing is done. That's where the resources and the time of these 6 retention managers ought to be spent, not contacting every single account. Some merchants don't want to hear from their providers, and other accounts need that ability to really walk them through troubles, any difficulties with setup, or perhaps training. These
Sure.
are all things to consider when it comes to retaining an account. And again, all we do is simply point you to where you should be spending your resources. And at the end of the day, work with you to ensure that the right message is deployed for those accounts and that you're doing everything you can do in order to keep them.
Yeah, and I think the other thing that's interesting to point out is, I mean, there is so much variation right now in the payments industry as far as you say, well, we're an ISO. I don't even know what that means anymore. Does that mean are you going after restaurants with point of sale? Are you selling standalone terminals with dual pricing or cash discounting? Are you selling B2B merchants on B2B right? And so I think what's interesting is without the data, I love the example you gave, Sebastian, about providing a free point of sale system to the restaurant that is likely to attrit. Unless that ISO has fairly concrete data that says this account is likely to cancel, they are never, ever going to make that investment. Right. You're not going to like blanket and say, I've got a great idea for our company. Let's reach out to all of our restaurants and offer them a free point of sale, even though they're already processing with us.
Mm-hmm.
Yeah.
No, you just lost, $10 million, right? Like depending on how large your company is, you're not going to do that. But if you say, well, here are the 300 that we know for sure are likely to cancel over the next 12 months, is it worth a free point of sale system to retain? Yes. Now we reach out and offer it, right? So I think what you're doing, Sebastian, is so interesting because you're giving that data. Without that data, you can't do those strategies. It's not practical. It's just not.
You're guessing. You're guessing. And it's no different from again. When you're considering, again, it's not free POSs to everyone who we identify to be at risk. No, it's maybe everyone who processes at least $50,000 per month,
who
right?
fits this particular MCC code or whatever.
Right, exactly. Like we can be very surgical when it comes to deploying these type of strategies into who, which is again, it's no longer a blanketed approach. Hey, free terminals for everyone. No, although this is kind of where our industry is moving, but it's more of like who deserves. It's not even who deserves. Who do I want to spend the additional funds on to make that investment on my client, so I can ensure that he will stick around with me for another 24 months in the long run. Again, that is very exactly, that is very valuable, I'd say.
Yes.
Not only for our industry, but for any industry in general that is dealing with churn.
Yeah, love it. So we already kind of touched on this, but I want to just isolate this question because you mentioned that a lot of the churn is going to Toast or Square or Stripe or whatever. And there's so many now of these companies that are competitors to the traditional legacy kind of ISO agent model. What I have seen of some data, just from a little bit of, there's some public data out there with Toast and with Square and others. It does seem like their attrition seems to be like significantly lower. I was actually just yesterday talking to a really, really large processing company that everybody would know. And, their attrit is 20% annually. It seems like Toast and Square are like below 10% as a general rule. Why is that? Would you have any insights of broadly, like what should our industry be doing broadly? And, why is there this kind of disparity between the two models?
If I were to boil it down, I think, again, there is a lot of private equity money in our industry, right? A lot of ISOs out there that are backed by PE firms. You have to understand a lot of these, Squares, Toast, Stripes, they don't think like payments companies. They don't act like payments companies. These are tech firms. These are tech companies that leverage technology to do their job better. The valuations they have, the resources they have. These are not the resources that an ISO has access to, right? It's not like they can just go back to their VC and say, hey, I need an extra 50 mil so I can work on bringing, more proactive retention solutions. Absolutely not. These guys have already the resources. They have the team of data scientists working on these problems. And many times, someone like Square is proactively reaching out to their merchants and saying, hey, I noticed your cash flows have declined in the last 3 months. Do you need a loan? Before the merchant even thinks about it. So again, let me just clarify. The Stripes, the Squares, the Toast, they are doing what we're describing right now. It's not this is like ahead, this is the future of retention. This is only going to be available for very few in the next 5 years. No, this is today. And these players are currently actively deploying and using data to improve the customer experience. I mean, this is a standard when it comes to tech firms, right?
Right.
How do we get better data science? And the thing with, let's Square is kind of the big elephant in the room. Square not only has data about processing information, but they also have information coming in at the point of sale.
Sure.
So this is information that is usually available at, let's say at a TMS, terminal management system, that many ISOs don't have access to. So now couple the additional resources with the additional data and the willingness to do something about the churn numbers, what we have is essentially a lower attrition rate, a stickier product, and an ability to proactively engage customers before they're out the door and before they decide to go and shop around for other solution providers.
Yeah, I think it's so important to understand that, no matter how smart you are, your decision cannot possibly be better than the data that you have available to you. Right. And so it's like, well,
So
we're not saying the people at Square are smarter necessarily, although they do hire a lot of smart people, but we're not saying that people at Square are smarter than the people at the average ISO. What we're saying is that when they sit down to make a decision about the direction they want to go from a technology perspective, the direction they want to go from a retention strategy, they're able to leverage massive amounts of data and data scientists and people like you employ, Sebastian, and they have these people in-house and they're able to leverage all of that with this massive amount of data. So they're just able to make decisions that are data-driven, where a lot of times the ISOs are guessing, or even worse, not even guessing, because they just say, that I love the way you described it earlier. It's like, well, attrition is attrition. It happens. Cost of doing business. What are we going to do about it? And it's like, well, yeah, but actually there is something you can do about it. You just don't have the information. And I think a lot of them need to wake up to the fact that, it's not like you're going to be able to provide them with a spreadsheet that says like, this is the definitive list of every merchant that's going to cancel in the next 12 months if you don't do something, but there's probabilities. And so you could say, right, here's a list of people that are highly likely, highly probable. So, so here's my last question. So this is a really tough one to answer. And, you may have to go in general terms here, but I'm just kind of curious. So let's take a retail ISO. They've got, maybe 5,000 mids. If they were to implement, what you have to provide, your software, your algorithms, et cetera, and then they were to take your advice and actually do something about it, right? What kind of an impact would that have on the company, whether you want to go financially or whatever? I mean, EBITDA, I don't know, like however you want to describe it, like why, give us the pitch of like, what's the impact going to be on this kind of really pretty small retail ISO with 5,000 mids? Like, what are they going to see as a result of doing this? And then our audience can obviously extrapolate from there if they're a lot larger.
Or to put it this way, the happiness quotient.
Yeah, right.
Show me the money, basically.
Right.
Yeah, exactly.
Exactly.
Yes. Yes.
Let's take this very, excellent question, James. Let's take this a little high level, an ISO. We actually did a case study on precisely a retail ISO, roughly with about 5,000 mids or so. So I do have some numbers on top of my head.
Cool. Okay.
But you can imagine an ISO with about 5,000 mids, they're processing roughly about, let's say, $1 billion in sales volume every year, just to keep it conservative.
Right.
Out of that $1 billion, 10% of that, again, conservative, 10% volume churn. So we're looking at roughly about $100 million in sales volume guaranteed to go out the door every single year, right? Now, let's take that a step further and say, okay, roughly 1% of that is going to be net revenue for me, for my shop, after I pay interchange, network fees, etc. Right? So we're looking at roughly a $1 million in net revenue problem that I'm not dealing with every single year, right? Arcum can actually identify many times with good data. That's the big caveat.
Right.
If we have transactional information, we have service or ticket information, and we have product information, we can on average capture up to 50% of that at-risk volume. So we're looking at roughly $500,000 in savings when we charge that particular ISO $5 per merchant per year. That's a $25,000 investment for the year, and they have the potential to save up to $500,000 in net revenue.
Nice payback.
It would be a very nice payback, right? And that again entails the ISO actually reaching out to the customer, proactively engaging that customer, but it first begins with focusing on who requires this additional touch point, who requires this additional service, this additional product offering. And in many times, you can actually use this opportunity to cross-sell on new opportunities and cross-sell on new solutions that maybe the merchant is unaware of. So for example, if we flag an account, and this happens to be a tire shop that is doing, $200,000 in sales volume a month, and we identify that he's at risk of churning because of economic reasons, well, wouldn't that be an easy no-brainer to put them into surcharge and cash discount or dual pricing, for example?
Mhm.
Now you all of a sudden alleviate the burden of credit card processing fees for the merchant.
Right.
You help them by providing an additional solution that it's at your disposal.
Right.
Maybe the merchant was unaware of that, and now you all of a sudden have changed the dynamic from having a at-risk customer to now having a customer, a loyal customer who's unwilling to switch because you were there for him in his toughest times.
Yeah.
I think that's the real value of what we provide.
Yeah.
Mhm.
I
Yeah,
like
that's
it.
great.
Yeah, I think that's great. I think it's so interesting to me that you're talking about a 20-to-1 return on investment year one and that's for a really small retail ISO. Extrapolate that same return on investment for the company with 300,000 mids, and it starts to be really, really interesting. So, okay. So last thing here before we let you go, Sebastian, this has been so interesting, so insightful. I always love talking with you, as you know. Tell us where people can go to learn more. And give a little bit more specificity. Obviously, you don't want the individual agent reaching out. Like, who do you want to reach out to you, and where should they go to learn more?
Absolutely. So as long as there is roughly about 5,000 merchants, that's usually our sweet spot. 5,000 merchants and above. By that point, is a more mature ISO where
Sure.
data collection is a priority. Because again, without data, we're as good as the next person guessing. So our value is derived from the data that we have access to. So
Right.
you're normally ISOs with around 5,000 mids who focus in the card present space, restaurant, retail, brick and mortar. These tend to be higher churn sort of verticals, and that's pretty much where we're primarily focused around. In terms of reaching out, I'm Sebastian Builes on LinkedIn. I'm pretty active there sometimes. We're actually going through a rebrand, so we'll be dropping the partners. Instead of arcumpartners.com, will be arcum.ai. You can visit us there, book a demo if you'd like to learn more, or leave a message. We're very, very, we go to all the shows. We try to be there and make sure that, we're pretty accessible for the most part. So if there's any question at all, even if it's just something like, hey, what are some things that we ought to do in order to reduce churn, and you're not our client, reach out. This is all we do. We love talking about churn, ways to mitigate churn, and how to leverage data in order to bring better business decisions. This is, we hope to bring some value to the industry, whether or not you're a client or not.
Awesome.
And just so for folks that may not be watching and are listening, it's Sebastian Builes, Builes. That's your
Correct.
LinkedIn, correct? Okay.
That is my last name, correct, Patti?
I just want to make sure, because sometimes, we hear things and we spell them many different ways.
Yeah, very good. And you said the website is arcum.ai, right?
Correct. We'll be going through a rebrand, and should be done with our new site sometime next week. I would imagine.
Well, before
Awesome.
this goes up. Sure.
Yeah, this will by the time this goes out, it should be live. So awesome. Well, Sebastian, thank you so much for your time and your insights. Always a pleasure, and I really appreciate you taking the time.
Absolutely, guys. Thank you so much for having me. And Patti, James, it's always great talking to you guys. Have a great one.
Thank you. You have a great one too, my friend.
Bye-bye.
So as a industry coming up company like myself, Alder Financial LLC, what would you suggest in terms of advice about going about the process of getting people their applications, getting them approved for a plethora of products, as
Sure.
well as just going over their financial history and their bank statements?
Yeah. So basically, correct me if I'm wrong here, but you're primarily doing merchant cash advance.
Merchant cash advance. I'm really just doing like a full service. I'm
Okay,
really
so you're doing merchant services as well.
Yeah. I'm also doing merchant services. Yeah.
Got it. So, I think the first thing I would point out here is there's a really, really big difference between prospecting and selling MCA versus selling merchant services.
Yeah.
Right. Like, one of the reasons I'm really bullish on selling payment processing and other technology solutions versus selling MCA directly is that you can't really sell MCA per se. Like, 1 out of every 40 to 60 businesses really could use a merchant cash advance. But the
Yeah.
problem is if you pitch it to the
Absolutely.
other 59, they're going to be really upset that you pitched it to them. Like,
Absolutely.
you know what I mean?
Absolutely. Yes.
So I've always found that really challenging. It's funny. I actually had a MCA company a long time ago, and I had a sales rep who their job for like a month was like calling and selling merchant cash advance. And we did it for about a month. And I was like, you know, and I consider myself pretty good at sales. And I
Yeah.
worked on the pitch and worked on the script. And at the end of the month, I'm like, no, we're never doing that again. So,
Yeah.
so what I would say is, and the reason is because again, you know, we got a few deals, but it was like everybody else was like, why are you pitching me this 30%, you know, loan, you know? So
Yeah.
what I
You gotta
found,
stretch out the terms.
yeah. So what I found is, I would say number one is as far as what you lead off with right now, the things I've seen that work really, really well is that you're leading off with either dual pricing with merchant services, or you're leading off with some kind of technology solution. If it's a large enough company, you might be leading off with cost savings, not like reduced pricing per se, but like more like consulting. Like I'm going to help you make sure that you lower your cost of processing payments, that sort of thing.
Absolutely. Yes.
Interchange optimization or whatever. So that's the first thing I would say is, you know, when you're trying to get it all going, definitely start with one thing. You always have to have a beachhead. I just talked to one of my sales guys about this morning that, you know, like our company, we sell a lot of different things to payment processing companies, and it's tempting to try to sell all of it or try to sell the biggest thing that you can
Yes.
sell. And what I found is it's actually a lot more effective and efficient to sell, like maybe not the smallest thing you can sell, but generally speaking, it's like, what's the easiest yes I can get to where I can get some momentum and actually get a customer quickly,
Yes.
right?
Yeah,
Then you
have to
come
build up
back
the
and say,
you
by
gotta
the
build
way, we
the
offer this and
rapport.
this, you know? Yeah, yeah,
Absolutely, yeah. Building up that relationship's kind of tough too, because you got a lot of people that are return customers in this industry. So if you're calling like cold leads
yes,
and you get someone that's already has like 2 positions out of 3 or 4 positions out, and they need a reverse consolidation, and you actually have someone, it's hard to gain their trust.
yeah,
Because like
yeah,
they don't know who you are, they don't know like where you're coming from. You're
right,
not with you're not with some major conglomerate. You might
right,
even have lenders that are like an actual financial conglomerate, like a lot of people do,
yep,
but you're not actually, you might have them as a partner,
right.
but they don't know you from
Yeah.
Adam. So
I will tell you, because let me give you a couple other thoughts about that. So one of the best ways I feel like if you really are trying to drum up MCA business, you need to think of it more as an educational process rather than a direct sales process per se. So like one of my favorite things, and something I did a long time ago, is write a book, like an ebook about, you know, merchant cash advance with a question mark, or 3 keys to capitalizing your business with no credit,
yeah,
right? That kind of a title is going to grab their attention. Then write the ebook and talk about, without getting too much into depth, but kind of talk about the mechanics of it. How does it work? What does it mean if you have to roll it over? What do I do if I ran out of money and I need another cash advance, but I haven't paid off the one that I have? How does that work? So I think writing like an ebook about that, making maybe even a couple of videos. You've got a nice setup right now. I mean, you know, making some
yeah,
videos or whatever, and then sharing that. And so now you're reaching out to people and saying, hey, something I've done for my local clients. We have a lot of clients with questions about merchant cash advance. How do they get capital? How do they structure it if they run out of money early? The only reason I'm calling you today is I wanted to send you my free ebook and the 2 videos that I made about this.
yeah.
Right now, they're going to be a lot more receptive to
Absolutely.
get that. Then you follow up.
One thing I've noticed with a lot of clients is, especially like if you're offering a little bit more, like if you're offering like equipment financing, and like other like not necessarily mercantile services.
Right.
I have some clients right now that actually want to refinance an SBA into a 4-year business term loan, just because the SBA term loan, that the SBA terms like 10 years. I mean, it's very few and thin, but
Yeah.
I do have some clients that are even just trying to repackage into smaller terms.
Right.
And that's the thing with the merchant cash advance is realistically trying to push a 3-month thing is kind of hard.
Yeah.
Especially like a 3-month term, depending on like how much you're financing. Because
Right.
if you're doing like 10 to 14K, it's
Right.
okay.
Right.
But realistically, a lot of people want like half a year or 9
Right.
months to actually be able to refinance and repay
Yeah.
them.
And again, I think what's interesting about this conversation, I mean, there's the steak and there's the sizzle. We've been talking about the sizzle, which is how do we make this sound good? How do we sell it? Right. But the steak,
Exactly.
the steak piece of this is, I hate to be the one to say this, but I mean, MCA is not dead, but it's dying. And
It
the
is.
reason, and the reason it's dying is very, very simple. MCA
Yeah.
is based on a premise that we're going to lend money to people who are highly at risk of default, and we can't really understand all the variables. So we're going to charge them a lot, and we're going to share a lot of it with the person who signed them up. That is an outdated idea at its core, because now you have Blue Vine, you have Cabbage, you have all of these others, Pipe. So Fundera. So now you have all of these competitors that are saying, well, wait a second, really? We can't figure this risk out? I think we can. Let's leverage AI. Let's leverage algorithms.
We're repackaging it into working capital loans.
Yes.
And realistically, like a lot of people are trying to do like accounts receivable financing and invoice factoring.
Yep.
Which is kind of the same, but realistically, with a lot of merchant cash advances, the only people I really approve of, like in my personal company, I really fund through with merchant cash advances, or like the serial entrepreneurs that are realistically just trying to pay for like 4 different companies out of pocket, and they have low credit.
Yeah.
So,
It's not a great.
If you need something, I got that.
It's just not a great fit for the average business. And it's like, the one you mentioned of the 10-year SBA note wanting to refi into a 4-year whatever. I mean, it's like, that's just stupid. I'm sorry, but like anybody with any business sense knows that's dumb. You're going to reduce your cash flow and you're going to accept the higher interest rate. It doesn't make any sense. So it's like, to me, I think that's the big part of it. And that's one of those reasons that in my mind, if somebody's going to reach out to me because I've educated them, or because they're with me in another service, and they're going to reach out to me and say, James, we really need some capital right now. I feel I'm going to sleep fine at night getting them on an MCA. But I don't know that I feel great right now about going to market with MCA. Like, let me go convince people for an MCA. It's like, well, hold on. Have you tried the SBA route? Have you talked to Fundera? Have you been to Cabbage? Do you understand Blue Vine? So I feel like there's a little bit of even a moral obligation with that to kind of be like, well, wait a second, is this really the best option for you? Versus when you go to market selling a point of sale system, integrated software, dual pricing, whatever, to me, I feel great about that. And then I can build a big portfolio. Then I can just educate people. Hey, by the way, I have capital available as well, if that's something that you need. And then you have those conversations as they come.
That's how I feel, because like working as a direct lender is actually way harder than you would actually anticipate. They always try to pushing the industry. You need like 100K capital to actually start your own financial services. And like as of right now, I'm just brokering deals.
Right.
And like I can do direct lending if it's like below 20K. I can do direct lending.
Right.
But if it's over 20K, I don't have
broker
the capital, nor do I have like the attorney to actually work out the contract.
And let's be honest about that too. When you're talking about direct lending of your own capital, $100,000, you might as well go to the roulette table. And what I mean by that is some of, if let's say one out of
this industry.
Let's say 1 out of 10, which is very conservative. Let's say 1 out of 10 is going to default, and you lend money to 3. You have actually really good odds that one of those 3 is going to default, wiping out a third of the capital that you have put out. Like, these businesses only work at scale. What I think is a much more realistic approach is to do things. There's a lot of different programs that you can get with the MCA companies where they'll actually let you buy into a small piece. I'm sure you're familiar with this. You can buy into a small piece of each loan that they do, where you own 5% of the loans that you have put out there in the field. And then you're not only getting your commission, but you're also getting, a return on that actual money.
Getting return, and they're offering a higher commission rate as well.
Exactly.
If you're putting in, if you're putting in your own financial leveraging for that person to repay, realistically, they'll give you like that's what the industry is actually pushing a lot right now, is like commission rates. We're offering 2, we're offering 2.5, we're offering 3. And you do have some people that definitely need MCAs. Like some people were like, I want to cover payroll. Right. I have a new office that I'm expanding into.
Right. And there's an urgency to it. Yeah. For me, that's one of the big things is about the urgency. It's like, I'll get like one of my favorite examples. There was a guy who he had a fire in his pizza shop, one of my clients, and he had to get another pizza oven. It ruined his pizza oven. Ironically, they were able to get the rest of everything was okay, but the fire just destroyed his pizza oven. And he's like, look, I have insurance. They're going to cover this cost, but I have to go get a pizza oven like tomorrow or the next day, or I'm out of business.
I need this wire to my account right now.
Yes. And that was fine. We did, I think it was a $15,000 MCA. He went and got what he needed, got it installed very quickly. Then the insurance money came in and he was able, you know what I mean? That's where you need
he
an
worked it
MCA.
out. Exactly.
Yeah. So
You
yeah,
get, you
super
get a
interesting
lot of
conversation.
things like that. You get a lot of like miscellaneous needs. That people don't want to go through. What the thing about the equipment financing is, people love it only if you're doing like construction and like cranes and like bulldozers and stuff, or if you're doing farming equipment like harvesters. Because at the end of the repayment, they'll write it off as a tax return, or they'll actually write it off as a tax write-off. So they really love that. And if you're doing like other stuff like the business term loan, it goes like the Bureau for Credit Reporting and stuff. So people get to basically invoice factor that into their taxes and so on and so forth.
Yeah.
And
I think at the end of the day, everything you're describing, it's like, these are all issues that are fairly complex for a merchant to understand. And so whenever I'm trying to sell something that is complex in nature, which I mean, a good example is what we're doing right now, as far as for my business, I sell ISOs on stuff that's really complicated. And, you know, to me, it's about education. And so I always am thinking more in terms of that. I'll give you one other really good example of this. One of my absolute favorite things to do is to create a podcast. I've helped a lot of people do this, where it's like, nowadays, I mean, my goodness, you can get, I mean, the setup I have right here, I mean, this microphone, and I've got some other nice equipment here, but I mean, it's not that expensive. You can do a nice podcast for $500. You can get the equipment you need to make something sound good. And if you have a topic like, small business capital, well, I don't know, maybe I'm sure there already is one, but the small business capital podcast would be fantastic. That's a great lead source.
Exactly.
Every episode you do could be with a small business owner that you're interviewing, or with an expert in the industry. And, so to me, things like that, I always try to think more in terms of, let's become like the media company that's going to educate people about this topic. And if you run that model for 6 months, you're going to start getting a steady flow of leads, and those are going to be very well qualified and very interested in what you're selling.
Yeah, I've seen a lot of your content. I like the way you're positioning yourself within the industry as more of like as like an educator, as well as you actually offer your own services.
Yeah.
Because a lot of what owning and being the CEO of a company is creating a lot of content. Because nowadays you can, I mean, especially with what you were saying about the podcast and everything, because nowadays you can have, like, with social media and everything that's going on with social media and everything that has been going on, you can hire, like, everyone's doing it now. So now you can have like interns that'll come in and they'll help you out. They'll set you up. They'll offer you like advice, just because you get younger generation coming up through, and they're actually.
I've got a room on the other side of this wall here. I have a room of 4 full-time people who are all in their 20s that are on the creative team that do the video editing, that brainstorm with me about like, we're just about to launch our TikTok strategy, and it's
Very cool.
I don't use TikTok. Come on, I'm almost 40 years old.
I'm the same way.
But they're helping me, and we're going to put out a bunch of stuff on how to sell payment processing on TikTok. So, this has been fantastic. This is a really good conversation. Let's follow up again sometime soon and talk some more. But yeah, I think this is very helpful. I think the big takeaways are, if you're out there selling something that's complicated, educate. Lead off with one thing. You got to pick the thing you can sell and then go sell it, and then build that portfolio through your education, build those relationships, and then you can sell more stuff.
Absolutely.
Yeah. Good stuff, man. Thank you very much. I appreciate it.
Thank you, James. You have a good one.
James, this week I want to speak about tokenization.
Okay.
This is one of those perennial security methods that has found a niche in securing online and mobile payments.
Yep.
I go back to I remember writing about tokenization in the 1980s. I mean, that's how old the technology is, but it's matured and evolved over the years.
Yep.
And something came across my desk recently that really kind of blew my mind, that Visa says it has now issued more than 4 billion network tokens worldwide through its Visa token service, which is nearly double the number reported in 2021. And this is the really interesting thing. It's more than the total number of Visa plastic cards in circulation. Now, it says it has about 8,600 issuers and 800,000 merchants worldwide that are using the service. And that analysis shows tokenization used by merchants has led to a 28% reduction in fraud and a 3% increase in approval rates, which of course, drive improvements to merchants and agents and ISOs bottom lines. Like I said, tokenization has been around in the card world for a long time, probably in the card world for about 20 years.
And
It
can
was real
you,
big in the,
could you maybe zoom out for just a second for those in our audience that maybe are
Sure,
newer
sure.
to the industry? What is tokenization, and give us the broader kind
Well,
of
yeah, let
definition
me-
and how it differs from just a pure plastic card? Like, give us a little bit more context on that. if you
yeah,
would.
and I think this is probably the best way to do it in the context of cards. Okay, so in the context of cards, tokenization replaces that 16-digit number with a unique algorithmically generated digital identifier. That's
Okay.
the token.
Right.
Okay, so I have my card and it, 1, 2, 3, 4, whatever,
Whatever, right.
16 digits of numerals that gets replaced by a 1B2. That's its token, that's its identifier.
Right.
It
So as an
only
example-
works.
Go ahead.
Go
No,
ahead.
no, you're fine. No, I was going to say, like, as an example, would it be an example of tokenization? So for instance, our company, someone puts a card on file in our software. We then have that tokenized and store it so that later on we can go back and charge it again. So we generated a token for
Right,
that
without
card.
having to actually retrieve that number.
Well, we don't have to
Very
have them
sim-
like swipe or give us the card information every month. We've tokenized it and now we can gain access to that unique identifier.
Exactly. And then that's really where it gets used the most, is with these kind of digital services and cards on file kind of situations. Because what happens then is that if the token gets stolen, it's useless.
Right.
So, therefore you can, it makes the digital commerce a little bit more secure than it was.
Yeah, much more, right? So it's like if somebody grabbed, in the example I gave a minute ago, if somebody was to hack into our system, we don't have any card numbers in our system. We have these tokens.
Right.
Well, they can steal those tokens all they want, but we have it's encrypted on both sides.
Right.
And so it's not like you can't just like walk into your local convenience store or call to order pizza and give them
your
a
token. Right.
Not going
Right.
to get you any pizza. You have
Right.
to have the actual card number, which we don't have in our system. Therefore, it removes that liability from us, and we're not in that PCI scope because we don't
Right.
have the card number on file.
Yeah, and it can get a little more sophisticated, obviously, as you're in more sophisticated kind of business lines, but that's basically what it is. The other thing too about tokenization is that it eliminates the friction in the payments process, because there's no need to manually update that card information. You have those cards on
Right.
file,
Right.
one expires, it's okay. B of A just automatically replaces
Yep.
that card, against the token.
Right. Right.
Okay, so just automatically, updates it and credentials with the associated tokens. So here's how the issuance goes, just so people can understand this. A consumer, for example, registers their card number, security code, and the other account information with a digital payment service, like say your online service.
Right.
Okay, the service then asks Visa for a payment token for that account, for that registered account. Visa then reaches out to the card issuer, says, is this okay for us to issue a token to, Patti Murphy for use with James Shepard? Yes, it's okay. So then Visa replaces the card number with the token, sends it to you, and we go on our merry ways.
Yep.
The interesting thing is that it can be used for both online and mobile NFC type payments. It can also be restricted to a particular mobile device, a particular e-commerce merchant, or another example is unlimited number of purchases before it expires.
Right.
So here's the transaction flow. I initiate the payment. The merchant sends the token and transaction details to the acquirer or the processor. The acquirer then forwards that information to Visa, which sends it on to the card issuer. The issuer either accepts or declines, much as they would in a typical transaction. Sends the response to Visa, and the token and payment authorization are forwarded to the acquirer, and the transaction gets completed.
Yeah. And I think this would probably be a great time for us to talk about our sponsor.
And that's the perfect time, don't you think?
So NMI.com, like one of the things for those who are maybe newer in the industry don't understand, I mean, one of the main functions that the gateway serves is this idea of tokenization.
Right.
So, with NMI, they have their vault. So when I was giving the example of our company where we have people go on and they'll do our training subscriptions or our statement analysis service, we have all of our software tied into NMI. And so
Mhm.
when somebody puts a card on file, we actually use their API so that
Right.
when they're putting their card information on our website, it actually isn't even touching our server ever.
Right.
It's going directly to NMI.
Yeah.
NMI does the heavy lifting of communicating with the card brand to say, hey, CC Sales Pro wants to store this card. Can you give us a token?
Right.
And they get the token. Then they store in what they call their secure vault.
Right.
And so it's like a digital vault that they have all these things. And then they send back to us this token and say, okay, now anytime you send us that with our API authentication and all of that together, they will respond and say, okay, this is you do have this card on file, right? Or you have the next card after that one expired because they automatically replace it. And it's like, okay, what do you want to do with this information? It's like, well, we want to charge them, $1,000.
$1,000. Right.
They pay us $1,000 a month. Okay, great. Well, then they run that for 1,000. So yeah, so they, NMI.com has really been a pioneer in this because it's very challenging. It's very complicated to build out.
Right.
And they're building it out for the, as a processor agnostic solution. So that's why a lot of the ISOs and big processors and acquirers and everybody else, even PayFacs, like that's why a lot of them use NMI, because building that tech stack is like ridiculously complicated and expensive.
Yeah.
And they already have it. So I think that's really important. So that's nmi.com, which is our sponsor for the podcast. So it's great to be able to kind of throw them in with your insiders today, Patti.
Yeah. So, and I think, one of the things just to say about this is that as more transactions move online in the mobile devices, we're going to see a lot more demand for tokenization. And I think that these numbers from Visa, suggest that it's already coming to fruition.
Yeah. Good stuff, Patti. Well, thank you for sharing that with us. I think it's an interesting trend, but I also think I'm glad you brought it up because I think a lot of people in the industry don't even really know what that is.
No,
that's a really good little education piece.
Yeah. And to be honest, one of the things I love about my job is that I get to educate myself while I'm educating other people, because I did not realize that this technology had evolved that efficiently and that significantly in the card world. So
love it. Great stuff, Patti. Thank you.
Mhm.